On this episode, I'm going to be going over fair value gaps. I believe this is one of the core concepts of the way I trade. Fair value gaps, it is a 3-candle sequence in which the wicks of candle 1 and 3 do not meet. So if we look at candle 1 here and candle 3, we see that the wicks, bottom of this candle 3 and top of candle 1 here, the wicks don't meet. When the wicks don't meet, we create a fair value gap. When price makes a pretty strong move fast enough where the wicks don't meet of candle 1 and 3, you create an imbalance. And this serves as a magnet. It attracts price, but it also supports price in whatever the corresponding direction is. And it's important that you understand that, right? Not only does it attract price, but it also supports price in the corresponding direction, which means we can use them as a target, but we can also use them as a foundation of our trade, like to support it and then take a trade right in that direction. Let's get out of this and let's pull up now a 5-minute chart and show you just how fair value gaps operate. So if we go right here, right, typical bullish market structure, as price is approaching higher, we continuously get these pullbacks, which ultimately send price higher. And so we have these 5-minute fair value gaps. Price trades up, trades down, hits this 5-minute fair value gap, goes up. Price trades up, comes down. What does it hit? Well, we have a 5-minute fair value gap right here, and then it goes up. Price goes up, comes down, hits this 5-minute fair value gap, goes up. So you get the point, right? So generally speaking, bullish market structure, when price is very bullish, it will look like this. It will go up and it will come down and it will typically retrace into a fair value gap, and that will support price higher. It does this every single day. But now the important thing is, how do we properly utilize them? How do we know which time frames to look at? What does a 1-hour fair value gap mean compared to a 5-minute fair value gap? I'm going to go over all that. As you know, price is bullish. It will go up, retrace into fair value gaps, and go down. And this is fractal. This can happen on the 1-minute time frame the same way it can happen on the 1-hour time frame. But every time you switch time frames to find, if price is bouncing off a fair value gap, it's going to serve a different purpose. And so if we're very bearish, this would look like this, where price goes down, comes up, and then hits, bearish fair value gap, bearish fair value gap, bearish fair value gap, bearish fair value gap. Let's get into the real sauce now. Fair value gaps for me is used primarily in 2 ways. The 1-hour and 4-hour, we have the 5 and 15-minute. These are the 4 primary time frames of how I build about my biases, my drawn liquidities, everything utilizing fair value gaps. And now you're probably thinking, Patty, what about the 1 to 5 minute? Honestly, I don't use fair value gaps on the 1 to 5 minute time frame. Well, I don't use them anymore as a level of support or whatever, the same way I explained them in the beginning. On the 1 to 5 minute time frame, that's where my entries happen. And for my entries, I utilize inverse fair value gaps, which is when price invalidates a fair value gap. And we'll get into that in the inversions video. But right now, what I want to focus on is how I use these as my primary way of forming a narrative. But what I mean by forming a narrative is when I go into, every single market session, there's 2 things that I'm trying to do. Well, 3 things, I guess. For one is establish a bias. Where could price go now? Then see if the lower time frame aligns with that, and then find an entry. To say the least, this is my bias. This is conditions, and then this is entry. So that's what these time frames mean to me. The important thing is that you understand that on this higher time frame, the 1-hour and 4-hour fair value gaps, this establishes a narrative. It acts as a foundation for a trade. If I don't have a 1-hour or 4-hour fair value gap in support of my trade idea, then I truly don't have a trade idea yet. It's, very important that you get in the habit of having a foundation every trade. And that's going to help you avoid pattern trading and doing stupid shit that doesn't even make sense, taking trades that are low probability. And so then the 5 to 15 minute. What does a 5 and 15 minute fair value gap mean? Well, the 5 and 15 minute is transactional, confirms drawn liquidity. But the point being is my higher time frame, my 1-hour and 4-hour fair value gaps are the foundation. My 5 and 15 minute are the transactional aspect of it. It confirms the drawn liquidity because I'm entering on the 1 to 5 minute. In order for me to enter on the 1 to 5 minute, but have 1-hour and 4-hour concepts supporting my ideas, I need something transactional. I need a middleman. I need something to tell me, okay, the higher time frame is now aligned with the lower time frame. And we find that out using 5 and 15 minute fair value gaps, which I call conditions. Let's start off with how I build a bias. If I'm building a bias and I'm going into the morning and I see, okay, well, the most recent move we have on the 1 hour and 4 hour is that we're bouncing off this fair value gap. If that's the most recent analysis I make, then I want to find an idea on the lower time frame that supports that. So if I'm seeing on the higher time frame, the most recent fair value gap I'm bouncing off of on the 1 hour, 4 hour, right, is bullish, then ideally I'd want to look for longs. It's very important you understand that. Let's say after we bounce off this 1 hour fair value gap and we start trading higher, eventually we tap into a 1 hour, 4 hour bearish fair value gap. Well, now the most recent higher time frame fair value gap that I'm inside of is bearish, right? So what does that mean? That means I probably should be looking for shorts, but everything is an assumption until you build confirmation. And that's what I'm going to teach you throughout this series, bro. It's going to be how to turn assumption into confirmation. Because truthfully, you never know what's going to happen in the market. There's no such thing as predicting, all right? But there is highly calculated, probability-based reacting. But let's stick with this original idea. We identified that on the higher time frame, we're bouncing off a 1 hour bullish fair value gap. Next, I want to see the 5 and 15 minute. Let's say I'm bouncing off of this leg. We'll grab this leg right here. Bang, 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 bang. And then on the 5 and 15 minute, I see that we tap into a 5 or 15 minute bullish fair value gap. So not only are we bouncing on this same higher time frame fair value gap, but we also identify that we're bouncing off now a 5 and 15 minute fair value gap. And so now what happens is I've confirmed that this bounce on the 1 hour, 4 hour time frame is valid because it also aligns with what then happens to be a 5 and 15 minute bullish fair value gap tap. Pretty much. Fair value gaps, I see them as sort of opinions more so than facts, because you can have price trade into a fair value gap, tap it, but then still end up invalidating it, still end up running through it, right? You can still have price hit this 15 minute, right? After hitting this hourly gap and then trading up and then hitting a 5 and 15 minute and respecting that, you can still have this happen, but then price just decides to shit the bed lower and invalidate all this. And so just when you thought, oh, well, it's valid to long, well, kind of wasn't. You jumped in too quickly. This is the most important thing I want you to pay attention to right now. This is how I build biases. This is how I build drawn liquidities. And now I'm going to show you in live time. So we're going in to this session, right? It's 8 a.m., about an hour before market opens. And I want to look to see what is the most recent fair value gap that I'm bouncing off of. And so if I look where price is currently trading, down here, yes, we were inside a bullish hourly fair value gap, but then what happens? Price trades higher and it hits this 4 hour gap. Before, we were inside that 1 hour, but then we traded up to the 4 hour. And so now this is the most recent PD array. And so now if I want to confirm that price is bearish and gonna be bearish off this level, I need to see 5 or 15 minute confirmation usually to prove that. And so price starts going lower. Awesome. And then what do we see? Price opens up a 5 minute bearish fair value gap after hitting that 4 hour. And then this is going to confirm that price wants to go lower. And as you can see, it goes lower. And until you start seeing invalidations of these 5 and 15 minute fair value gaps, you should assume that price still wants to go in that direction. So now if I see like, okay, we had this bearish 5 minute gap and we end up invalidating it, we end up closing above it. Now what am I going to expect? Price to go higher for a bit now. And so then it goes higher. Awesome. That's why these 5 and 15 minutes are so important. Now let's apply the same ideas on the 5 and 15 minute chart. We just did on the 1 hour and 4 hour. We saw price go from bullish to bearish on the 1 hour and then hit a 4 hour bearish fair value gap. And now we're seeing the same thing happen on the 5 and 15 minute time frame, right? Price was bearish. We then confirm it with this bearish 5 minute fair value gap. Price trades into it. Then what is it most likely going to do? Go lower, and then eventually we open up another 5 minute, but in this one gets inversed, and we'll talk about that later. Practically gets invalidated. Price closes above it here, and then it starts running higher. And then what do we hit? Now what's the most recent fair value gap that we're on that we are inside of in the 5 and 15 minute? It's going to be this 15 minute bearish fair value gap. We had this 5 minute bullish here, but this is getting invalidated. So what do I anticipate from this? Well, now it's probably going to go down, and I was right. So it really depends on market conditions. Sometimes you're going to get chopped. Sometimes you're going to get good price action. I'm trying to be as transparent transparent as possible here and literally pull up charts that I haven't seen, or at least don't remember, right? Because this is from November. Obviously I traded, but I don't remember. Your most recent 1 hour and 4 hour fair value gap and your most recent 5 and 15 minute fair value gap are going to tell you the best story every single time. The goal is to be reactionary to the most recent higher time frame or 5 and 15 minute time frame fair value gap that you're tapping off of. If I'm building my bias, what am I looking for? You know, what is the most recent 1 hour, 4 hour fair value gap that price is bouncing off of? And if I am trying to find an entry, what am I looking for? The most recent 5 and 15 minute fair value gap that price is bouncing off. So let's take a day like this, for example. First thing I'm noticing is, okay, price is bouncing off this 4 hour bearish fair value gap. We took the high inside of it. We're still inside this 4 hour bearish fair value gap. That is currently the most recent PD array. I would be thinking in this case, better to short. Does that mean I'm taking shorts yet? Not quite. Market hasn't even opened. So let's just play this smart. But as of now, we know that we're bouncing off this 4 hour. Now below us, we also have another 4 hour fair value gap. In my head, this is how I think. Well, right now we're bouncing off this 4 hour bearish fair value gap. Below us, we have this 4 hour bullish fair value gap. Well, that tells me price will probably want to go from this bearish 4 hour down to this bullish 4 hour. So I can think about this two ways. If I find confirmation, I can take shorts if everything aligns with the 4 hour bullish gap as my narrative, right? This is like the narrative behind it. This is where I believe price wants to go. And then this is the foundation of it. And so this is a foundation of the trade and this is a narrative. Now what that means is if I were to take shorts, I have a foundation behind it and there's a narrative behind it. Price would want to go down to here because there is, you know, a 4 hour gap below. We have this low resting inside the 4 hour. And so I'm not going to look for longs or be bullish until we take that low inside the 4 hour. Like I said, if price trades into here, despite it being inside the 4 hour, it still hasn't taken out that low inside of it. So that's something I do very particularly. It might just be me, but it's how I have a very high win rate. We take this low. Now we're inside this 4 hour gap. This now becomes my foundation. If I wanted to look for longs, I have a foundation. And is there a narrative now? Yeah, we have this unfilled 1 hour up here. We have this unfilled 1 hour up here. And so now this becomes my narrative. And do you see how it quickly flipped? And so I use the idea of newly tapped 1 hour and 4 hour gaps as my foundation. And then I try to find a narrative, which is usually an unfilled, you know, hourly gap or just a reason for why price would want to go higher in this case. But it doesn't have to be on the hourly. It can be on the 5 and 15 minute chart. So let me show you that. So now I go down to the 5 minute chart and I see, you know, we have this narrative here of these unfilled hourlies and we have the foundation here that we're bouncing off of right now. Like I said earlier in the video, what are fair value gaps? And it's important that you understood that concept to begin with. They are magnet, but they are also support. So in this case, we're using this one as support and this 15 minute as a magnet. And so the 5 and 15 minute chart, when you're able to identify those 5 and 15 minute unfilled fair value gaps, that serves as a magnet for price. So now this becomes that narrative. If it's in higher time frame as well too, that's great, right? We have also the 1 hour bearish fair value gaps above that are unfilled. That also serves as our narrative, but I'm usually targeting things that are within my range, right? Not on the higher time frame. So my higher time frame serves as my bias building. My entries are in the 1 to 5 minute. My targets are like 5 and 15 minute. Point is, let's actually phrase it like this. We know that on the higher time frame, there's those hourly gaps above that we called the narrative. This is a 15 minute chart, but on the 1 hour chart, we have also unfilled fair value gaps. And so we know that that's serving as a magnet, but we want to also find our targets on the lower time frame, the lower, but the transactional time frame, the 5 and 15 minute. And so here I mark out these unfilled 15 minutes, and then I can also use 5 minutes. And so if I look at the most recent 5 or 15 minute fair value gap that we're in after hitting this foundation, after hitting this 4 hour gap, it's this 5 minute bearish gap. But now what I'm thinking is if this foundation is truly going to be supported and we're going to go higher, then we should just run through this 5 minute bearish fair value gap. And, you know, we should close above it. We should invalidate it. But if we're going to go lower, we're going to respect it and then start going obviously lower. We're going to get an inverse of the downside. But now let's see what happens. This is the most recent 5 or 15 minute that we're in, and price eventually closes above it. Notice how that worked. At first, price trades into the most recent 5 minute bearish fair value gap here. It ends up supporting it. Well, supporting it, more like pushing price lower. And then what happens? Eventually, this is still the most recent 5 or 15 minute gap we have. We close above it. We inverse it. And so what do we anticipate now? Now that this gap has been inversed, now that we're not inside a 5 or 15 minute fair value gap, the only thing that's left means, okay, we have this foundation, this most recent 5 or 15 minute bearish fair value gap get invalidated. And now we have these magnets still above, these targets, these unfilled 15 minutes. So then that's where we could formulate a trade like this, where we can long towards these levels because they act as a magnet for price. I anticipate that price is going to go here. I typically wouldn't go for like a crazy, RR trade like that. I usually just go for 1-to-1. But in this case, I would see something like this and be like, oh, this is a great trade. It plays out even up to here. And so what I'm trying to get at here is it all roots back to the beginning where I explained to you, like conceptually, how fair value gaps not only serve as support, but also like a magnet and all this shit. And that's like the foundation of all my trading. I truly use fair value gaps in a way probably that not a lot of people use, just because it's very, I don't know, like, I won't look at this at price if it's inside this 4 hour unless it takes this low inside of it, and I can get into that in part 2 of fair value gaps. But for now, hopefully I didn't get too complex with this. But yeah, that's pretty much how I utilize fair value gaps.